Let's take a look at the commodity space now, where we have seen very, very volatile moves coming in. It really has to do with the global setup, where we have seen the IMF now cut the global demand growth for this year and next as well. Remember, we in any case have been looking at weak China data, concerns about US and China trade talks. So that really has been the reaction on the crude oil prices, more than a percentage point of decline for both Brent and NYMEX. And this is, we're off from 7-week highs. Demand, of course, has been a concern. And what is actually supporting prices right now, whereby the reason we haven't seen a complete sell-off is because it has to do with the OPEC and the allies output cut, which the markets are waiting to see an impact on. But everything else, including the strength in US dollar, has been weighing on commodities, not just crude, but metals and gold as well, is trading in the negative. Prathamesh Malya of Angel Commodities now joins us to talk strategy there. Prathamesh, hi. How are you looking at the crude oil prices? Because until now, every single day of 2019 has been in the positive. Today, we definitely seem to be taking it down.
Yes, Manish, I think the rally within last couple of weeks really tells that OPEC is really doing its bit and it's taking the effect on price. But now it's like a make or break situation here. We are at that point. $54 mark for WTI is really something, a make or break situation. I think either it has to go up from here or it has to come down. But really a dilemmatic scenario. But looking at the trend, I think positive momentum is here to stay just for next week or so. I think with volatility coming and plus US-China trade, GP of China at 28-year lows is ringing alarm bells for investors. So I think it's not, you should not be long in oil for too long, but yes, for a day or two you can be on the buy side and exit at around 3,850, 3,900 as far as M6 price is concerned.
Prathamesh, how would you look at the metal space? And as you said, the Chinese data has been on the weaker side, but that is something that we've known for some time now. The markets have been preparing for every weak data that comes in from China, especially for metal prices. Then what are we looking at? Because there is some deficit which has continued for many metal prices. Is the bottom still made? Are we waiting for demand to pick up? What would you want to watch here?
I think 2018 was really not the year of metals, and 2019 with US and China really not taking off that trade war. I think it is difficult to see how the demand side picks up as far as US and China goes. But again, it's a win-win or a win-lose situation for investors, whether to be on the buy side or on the sell side. But for me, as of now, I think the trend seems to be a little bit on the sideways momentum. But if I want to put a trade, I would possibly put my bet on copper, and as far as M6 price goes, I think 432, 434 is what we're looking at for just a day or two trade perspective.
I actually want to come back to energy, because one thing that we keep getting a lot of queries and questions on really is the natural gas prices. Very, very volatile. Have you seen the chart on that? The fundamentals, of course, are on the positive side, but this one actually tends to move just on weather forecasts. So how have you seen the prices?
I think natural gas, the first question is how do you trade this commodity first? Second, how do you put stop loss in this commodity? I think the volatility is 10% up, 10% down. You really cannot trade this commodity despite fundamentals being positive. I would suggest to avoid this counter unless people have a good appetite or good risk abilities to be trade in this commodity and hold on it and stay with the fundamentals. But this commodity does not really behave with what the fundamental says, and even if it behaves with what the fundamental says, you really have to be firm on your positions.
Well, that piece of advice is well taken, Prathamesh, what the natural gas prices do. But thank you so much for cautioning out and giving us strategies on all of those commodities. From that, let's move on to more stuff that's coming in from the World Economic Forum at Davos. And CNBC TV 18's Shireen Bhan caught up with Fatih Birol, Executive Director at the International Energy Agency. And they're talking about the outlook on the commodity prices, especially crude, going forward.
First of all, last year, it was not a very stable year for the oil prices. We have seen prices went up to $86, yes, which was a major burden for many oil importing countries, including India, China, many Asian countries, also Latin America and Africa. So, but the producers did bring new volumes to the markets, comfort the markets. It came to $55, $60. And I should also comment here, Minister Pradhan did a lot of effort, international efforts, to bring the prices down, discussing with me and other oil-related figures. Now, for this year, the good news is for countries like India, a lot of supply coming from United States, Brazil, elsewhere. But if the OPEC plus Russia cuts the production, this may well give an upward pressure on the prices. What I see this year is that US oil putting downward pressure on the prices, OPEC and Russia upward pressure on the prices, therefore lots of volatility. The name of the game this year in terms of oil prices is the volatility of the prices. We should be ready, but I don't expect huge price increases under normal conditions if there are no major geopolitical tensions among the key producers or consumers.
So given that the US is going to exert downward pressure on prices and OPEC and Russia upward pressure on prices, what's the kind of band that you expect prices to move within?
I think I see the floor price today is about $60, okay. But if it goes much higher, like we have seen last year, close to $90, this is, for me, a red zone for the global economy. Already weak. It can be even weaker with the higher oil prices. So therefore, we all have to act responsibly, producers and consumers, not to shake the global economic growth much stronger than it is now.
What's the outlook in terms of OPEC and Russia looking at further production cuts and curtailing production further?
What I read in the papers, what I hear from the colleagues, that they have firm intentions to have strong cuts in the production, but when and if they will do it and how much they will do it is up to them. But one shouldn't forget something. The game is changed. In the past, we only look at Vienna, what will be the decisions, if the price will go up and down as a result of those decisions. But now there is a reaction coming from United States, big time, shale. Last year, shale production increased very, very strongly. For example, Iran, we just talked about Iran is a very important country in terms of production. Only the one field in the United States, the Permian field, produces today as much as oil as the total Iran oil production. So there's a big production growth coming from the United States. So the decisions are not only taken in Vienna, but there's a decision coming from the United States in terms of commercial decisions, not political decisions, in order to bring more oil to the markets.
You know, since you talked about this rebalancing with the US gaining supremacy even when it comes to oil and gas, for a country like India, in light of the Iranian sanctions especially, will the US play a much bigger role going forward?
I think US oil and gas as a result of shale revolution is a big, big, big story. And we have already seen many impacts of that. If anybody thinks it is the end of the shale story in terms of its impacts, he or she is making a big mistake. Okay. We are just in the beginning of the movie. Yet to see a lot of chapters in this movie called US shale, both oil and gas. We will see implications for the markets, prices, energy security, and beyond that for the economy.
Very quickly, a quick question on India and the oil and gas scenario there. What's the expectation? What does it look like?
Now, India is a major economic growth, one of the brightest spots of the global economy when we look at the numbers today. But India uses a lot of oil at home with the increasing income levels. One of the suggestions I have for India is to look at not only the private increasing car ownership, but also look at the mass transportation, including the railways. At the end of this month, 30th of January, I am coming to New Delhi to have an international report launch on railways together with Minister Piyush Goyal to show how much India can benefit from putting even more emphasis on the railways. So India needs to reduce the oil demand growth as much as possible to decrease the reliance on the oil markets and making vulnerable to the international oil price changes.
All right, that's the IEA chief, Fatih Birol, saying that India should be putting in more emphasis on the infrastructure, in especially the railways. But more important takeaways really are that the US shale output is just the beginning of the bull run in sense of supplies there. And US soon would actually outpace all other major producers in the OPEC and will have a bigger say in the global markets when it comes to energy in sense of oil and gas. The crude oil prices, of course, he said, are not going to run away. But volatility is something that we should be prepared in 2019 when it comes to the global crude oil prices. Well, with that, though, it's a wrap on this edition of Closing Bell. But before we leave you, dear viewers, with the new rules for the DTH and cable coming into effect from Feb 1st, you have to choose the channels you wish to watch by Jan 31st. To keep watching India's #1 English business news channel, CNBC TV 18, just to call your cable or DTH operator and ask for CNBC TV 18 only for ₹4 per month. Stay tuned. After the bell comes up next after this very short break.